Okay, welcome everybody to episode 49 of the Volatility Barometer. So I see you've got a few people joining. Just wait for a few more people to come in. I do have to apologize. It might actually sound pretty terrible. As you've probably noticed, I'm in a new place. I'm always moving around. I'm in a new Airbnb. And unfortunately, this room that I'm sitting in is extremely echoey. So I hope this isn't a huge problem. If you want to see what I'm dealing with here, I can actually show you. This is what I'm staring at right now as I'm doing the live stream. I'm looking that direction. You guys are looking at all the stuff behind me, but you can see I tried to stack up some pillows. I put my computer on a towel. I'm hoping that I can cut down a little bit on this background noise, but unfortunately, this is the best we've got. It's a little bit strange. You know, usually there's enough furniture and whatnot to stop that, but I don't know. Sounds pretty bad. So the only way I'm going to know, I'm going to be here for about 3 weeks. So we're going to do 3 live streams from this room. I don't know. We'll see. I might have to go out and buy some sound blankets or something to clean this up. But hopefully it's decent. I do apologize, though, if it's a little bit echoey. So the first thing that I want to review is just a little bit of the recent work that we did. So here's an article. Hopefully you're seeing this correctly. There's an article recently, last week's live stream, somebody asked a question about what happens when options expire, especially in-the-money options expire. It can be a very big problem. So if you've ever been curious what happens to in-the-money calls, puts, whether you're assigned shares, long or short, this is definitely an article that you'll want to check out. It's on the website. Just go to the blog, go to articles. You're really going to want to know what happens to those trades. You definitely don't want to take on unexpected assignments. So definitely go read that. The other thing, there was no standalone video this week, but I do want to draw attention to something. I'm going to go on the screen share here. I don't know if you guys have noticed, but I've sort of revamped the clips channel again. So I'm starting to upload some clips again. These are just going to be short things, questions that people ask, certain segments from videos that I thought were really useful. And I'm just going to be uploading a whole bunch. Probably, I mean, don't hold me to it, but let's see if we can keep up with the schedule of every trading day. So maybe 252 trading days a year. Let's see if we can upload 252 clips. So the recent one where I was talking about why I manage a subscription service, you might be interested in that one. This one, a little bit of a rant on why you should never just blindly short volatility. What else have we got? This one, essentially explaining what short vol bias means and what volatility metrics would mean certain signals are better for volatility traders. The one I just uploaded today, I don't know if you're interested in this, 2-minute clip here.
中文是世界上最重要的语言之一，可是学习的过程中，正确的发音很重要。
I think you get the point. Just a bunch of clips. This one is me basically telling the benefits of learning a second language. Of course, I do speak a little Chinese. So hopefully you can go to the Clips channel. You will subscribe. There's currently only 700 subscribers here, but I think it will grow. And I think it's going to be a good place for me to put a bunch of the stuff that maybe wouldn't really make a good standalone video, but 2-3 minute clips. I think you'll find them interesting. And maybe they're more appropriate for binge watching. So probably in the description, I tried to drop a link there. It should say clip here for the Clips channel. Click that, go subscribe. Make sure that you hit the bell icon. Sometimes YouTube won't, tell people that I did a video. So it's going to have a little bell there. Click all so you're notified of everything that I do in the future. So do me that favor and let's get started. So remember, the first thing that we are going to do, here's the rundown today. I like answering some of the pre-submitted questions early on, and that'll give you all time to throw some questions into the chat. And then at the end, we're going to, maybe the last 30 minutes, I'll circle back and just try to rapid fire through as many as I can. So yeah. For those that aren't aware, on the YouTube channel, this is the Clips channel. We can get rid of that one. What am I looking for here? That's my daily email. So right here, this is the main YouTube channel. There's on the top, you can see videos, the lives, playlist. When you click the community tab, every week I'm going to submit this up here, and you can just go ahead and ask your questions. So the previous week, there was actually too many, and it took the entire live stream to answer them all. This week, it does appear that there are only 4. So We should be able to get through these no problem. Does look like, I just glanced at these quickly, it does look like one of them is a pretty long question. So if everybody's ready, let's go ahead and dive into these. And like I said, you can take some time and you can submit your questions in the chat, and we will definitely circle back to those. So, Isaac, this is a long one. Maybe in the future, people can ask one question. Even if you have 3, break them up into 3 posts, so we can kind of go through them one by one. But I will go through these one by one. So, have you backtested different ATR stops? I'm not positive what you mean by ATR there. Stops 1 times, 2 times, 2.5 times, compared to using the top of a candle or bottom of the candle that you got into the trade on daily time frame. So again, I'm not clear on what you're asking here. When I see ATR, I think average true range, which is essentially just the difference between the highest and the lowest point in a trading day, sort of an intraday time frame. I don't know if that would make sense in the context of your question, though. So let me just think for a second. What do you mean by ATR? Have you backtested different ATR stops? 1, 2, 2.5. All right. Well, we're doing this live, so I can't ask you any follow-up questions. I'm not sure average true range would make sense in that context. So I don't know what you're asking here, but I'm just going to give you a basic general answer here. I think I'm going to touch on it later on when we talk about stops, but essentially, you can never tell what the top or a bottom of any range is until after the fact. Of course, this is an entirely hindsight thing. So when you're talking about backtesting things, typically when we're backtesting, we're not using intraday values for that backtest because you're not going to have a robust data set. You're basically going to have end-of-day prices for everything, and then certain things like maybe the S&P 500, maybe you have open, high, low, close, but you're never really going to have detailed information on intraday prices going backward. So if your question is about backtesting, really all we can do is backtest end of day. Build the best you can, and then of course live trading is where you really hone in on your strategy. So I don't exactly know what you mean. I do have to apologize there. Maybe email me again or ask again for next week and clarify a little bit, and I'll answer it better. But this question, okay, a little bit long again, sorry. What do you think about tax for most normal people following your portfolio? I assume buy and hold S&P would have performed a lot better, even though your performance was better because of the massive amounts of tax that needs to be paid following your portfolio. Okay, I would assume it would all be the highest tax rate for an individual because of the shorter hold periods. Okay, so let's unpack this one. You know my style. I never like to outright tell somebody they're wrong. So let me sort of unpack why this is not accurate. Where's my, sorry, I'm a little lost here. So, okay, so when you're dealing with taxes, the first thing that I have to say always right off the bat, I am not a tax expert, and we do have members from 68 countries in the VTS community, so I can't possibly know the tax laws of 68 different countries. You are always better off paying a little bit of money, hiring a professional, and making sure that you get really good tax advice. I can only speak extremely general here. So in general, my portfolio, the VTS portfolio, is completely tax efficient. So that's why I say I don't want to tell you you're wrong, but actually when we're, this is today's daily email, this is our current portfolio. We've got 5 strategies with equal 20% weighting. All 5 of these strategies can be traded within an IRA account in the United States. Now, of course, different countries, again, different laws, you're going to want to find out what to do. But I'm a Canadian, so I know for RRSPs, for example, the whole portfolio can be done in a tax-efficient account. In the United States, about 75% of our community is from the United States. And then I guess we've got 67 other countries with minor representation. But we typically use the IRA structure. All 5 of these can be traded in an IRA. So you're talking about long ETFs only, no problem there. None of these strategies require margin. They can all be done in a cash account. So tactical balanced, again, it's just ETFs, long only. We don't short anything. We don't do any naked options, nothing. This one, long ETFs only. Now for these two, we are dealing with options. This is our volatility strategy. We use butterflies like UVXY and VXX butterflies. That one is defined risk, so does not require margin. And Iron Condors, of course, it's a 4-leg option, so you might think, oh, well, that doesn't count. But in fact, these are defined risk options. They don't require margin, and you can trade Iron Condors within an IRA account. So that's the first thing that I would say is for the vast majority of people, you could trade my portfolio completely tax deferred in any of the accounts that you normally trade in. Whatever you trade, everything that I do is also included. So then you've got to deal with a situation that, for example, let's say you were a person who has a higher income, maybe a much higher income, and maybe you also save a lot of extra money. So in that case, because you would get to a point where you're maxing out your IRA contributions, you can't just put unlimited funds into these accounts. There is a limit. Not many people breach that limit because, of course, what we know about people's saving rates, and half the country's living paycheck to paycheck anyway. But you're talking about, again, above and beyond the IRA, which my portfolio can totally trade inside there. If that's what you're talking about, then yes, we are dealing with a difference between long-term and short-term capital gains. So I do actually remember at some point, bear with me here, I might be able to find it. Calculator, here we go, that was easy. Long-term, short-term capital gains. Again, everything US-centric, so check your own country. I don't know where you live or what it is, but let's just do the US. You're talking about, for most people, income between $44,000 and $492,000. This is going to be basically almost everybody following my portfolio. If you were doing a buy and hold portfolio like stocks, bonds, gold, your typical pie chart, you could do that in a long-term capital gains account, and it's essentially tax deferred. As long as you don't sell anything in that account, it's going to be tax deferred, and then eventually you're going to be taxed at 15% because it's going to count as long-term capital gains. Difference is, for a short-term capital gains, it's taxed anywhere from 10 to 37%. Now, very few people are going to be 37. I don't suspect very many people are going to be less than 12. So we're talking about basically from 22 to 30. I mean, this is almost $250,000 income. I'd say realistically speaking, 22 to 35, probably leaning towards the 24 as the most likely, anywhere from 22 to 24. But the difference here, of course, is that this is not a tax deferred account. So every time you make a capital gain, you're going to be taxed at a 22, 24% rate. So the thing that confuses some people is that this isn't a tax rate based on the total amount of money. Of course, this is a tax rate based on capital gains. So if you have $100,000 in a taxable account and you make 10% rate of return that year, you actually, of course, get taxed at 22%, 25% of the $10,000 that you made. So it's really only a couple $1,000s in taxes. But you, of course, are paying that every year, whereas the other account, you can tax defer it and get a lump sum tax at the end. So there is a difference there, but it's not nearly the difference that you would think it is. It's probably, again, different people for different things. It's probably a few percent difference as far as rate of return goes. And that's also going to depend on what your rate of return for the buy and hold portfolio is. Because as we know, the S&P 500 itself, a lot of people think it returns a lot, but that's basically for our grandparents, the old, the S&P returns 10%. It's been decades since that's been the case. So here's the S&P 500 for the last 25 years. It's made 5.8% a year, 7.7 if you reinvest dividends. If you adjust for inflation, 3.2 and 5.1. So we're not talking about world-beating gains here, and that's buy and hold on the S&P. You got to remember, you're going to have a little bit of bonds, you're going to have maybe a little bit of gold, real estate, utilities, commodities. You're going to probably have a more detailed portfolio. You're talking about a low single-digit rate of return. If that's the case, then a tax-deferred account, even though it's 15% compared to 25, if it's a low rate of return, you're not talking about a very good compounding account anyway. And I would suspect, and I've talked about this a lot, I think the future is probably going to be lower return than the past. So the past 25 years, one of those buy and hold pie charts probably made about 4%, give or take. I suspect it's going to be even lower than that going forward. So you're not talking about a very big difference. Again, just to recap what you're saying, the reason I think it's a good point. Taxes are something that people should be concerned about a little bit, but you never want to sacrifice rate of return for taxes because in the end, practically speaking, you're not talking about a whole lot of money. But VTS, for most people, can be in any IRA and tax sheltered. All the money above and beyond that goes into short-term capital gains, which for most people won't be very much money, but let's assume you're a very high income person. At that point, if I had to ballpark it, I would say if you can make 2 to 3% more being an active trader, you should do that. If you were in a situation where you could choose between a 5% rate of return, buy and hold, tax deferred, or 8% active trading, short-term capital gains, I suspect long-term it'll be about the same. But you're not talking about, like you said, the VTS performance for the last 11 years is 23%. We're talking about a pretty significant gap there. It's not a situation where tax deferred is really going to make a whole lot of difference there. So hopefully that answers your question. It is a good question, but it is not really accurate because, again, like I said, everything I do, of course, we have clients from so many countries. I don't do any of the complex stuff that requires margin accounts and high level of trading. I put all of that stuff into the VTS option side of things. If you really want to be an active trader, maybe you can make 20% on an option strategy, but that wouldn't be allowed in an IRA. My VIX options, for example, I could even show you that if you were chasing a little bit higher performance, for example, our VIX options has made 24%. This is not efficient for a tax sheltered account. You can't do that because it does require short straddle options on the VIX. You're never going to be able to do this in a tax sheltered account. But the vast majority, and like I said, the entire VTS portfolio, 100% of it can be done in an IRA. So just so you know, it is actually tax efficient. Lastly, one of the main issues with SL, sorry about these abbreviations, are throwing me off. Stop loss, maybe? Okay. One of the main issues with stop loss is the trade going against you initially, then working. Okay. I know a lot of traders in the Market Wizard books talks about getting out of trades that don't straight away working. So that aren't working right away, I guess they say you should cut your losses and get out. Okay, I wonder, looking back, at how many trades that don't initially work actually never end up working out, and you should just quickly take a small loss and move on. So, okay, I like this question. This is good. You're essentially talking about how quickly you should stop out of trades. Now, for me personally, actually, before I delete this out, I was going to say, I've been trading options for 16 years. I've been trading Iron Condors for about 15 years. And actually, one of the original strategies in the VTS portfolio when we launched in 2012 was the Iron Condor strategy. It's been in the portfolio the entire time for basically 11 years. And the only difference is right around here, we started including several other complex option strategies as well. But for the first 8 years, it was just this strategy. It was 25% of the whole portfolio. So this has been in it since day one. This is our Iron Condor strategy. Now, I've been trading not only for the 11 years it's been in VTS, but at least 3 or 4 years before that when I was building up my skill set, before I launched it live. So in my 15 years of experience trading Iron Condors, I find that a 50% stop loss and a 50% stop gain is the ideal amount. Now, what you're talking about would be somebody defaulting much lower, like 25% or 20%. Essentially, if the trade stops working and you're a week or two in and it's not working, I guess that Market Wizard book is telling you to just shut it down. What I think would end up happening, and I've tested this extensively for a long time, every possible thing I can think of, 20, 50, 80, done wide body, narrow Iron Condors, long dated, short dated, all kinds of systems. And I have honed in on the ones that work the best. 50% stop loss, on the one hand, allows you to let a trade develop a little bit, because there are times when the trade is down and then it recovers and it's up. If you look at the market, I'm going to get into this in a little bit later, but let's just take the Qs, for example. I'm going to touch on this in a little bit, but I opened a trade here and I closed the trade for a stop loss here. But if I was using your system, I probably would have stopped out about right there. But sometimes you have to let the trades develop because markets do chop around. Let's try to go a longer time frame so you can see this. Markets do actually chop around a little bit. So we don't want to go from the high, but let's say from here. You kind of have to let things play out a little bit, right? And then if we zoom into the very tail end, you can see what we did. You don't want to stop out too quickly because then you're facing a situation. I've actually got a trade open. Let's just go right to it. It's right in the middle now, so it's working out great. But if it goes down or if it goes up, I would be losing money, but I wouldn't be stopped out yet. That happens all the time. So I feel like allowing it to go at least 50% before stopping out, that's going to allow me to maximize my wins. But if you look at this picture, you also don't want to allow it to go too far off the wings. So you don't want to let it go 80% or 90% because the typical very safe iron condor that we trade, slow moving, it means wide wings, very wide on the edges, long dated contracts. It means that the loss can be more than the gain. So that's why I also stop loss out at 50% because I'm not going to let it go all the way over here. If it's not working and it's way over there, yes, it's definitely time to get out of the trade. But if it's just down in this range, no, you don't want to cut those off too quickly because that's completely normal. When you enter an option trade, at the moment you enter the trade, let's give you an example here. Let's say I was to open something on the VIX, right? A single straddle on the VIX. It's trading at 18, so let's show you a straddle at 18. You can see that pretty much no matter what happens initially, you can see this pink line, or we can make 19. Let's see if that's better. You can see the pink line is an arc. That's the daily profit curve. So pretty much no matter what happens this week, this trade is going to be down before it's up, right? This is a short vega, long theta trade. So the only way that this makes money is the passage of time. This is going to be down, almost certainly. It's going to be down a little bit before it starts making money again. You don't want to be in the habit, the price is right here today, you don't want to cut it off every time it deviates a little bit. That's just going to be a long string of stop-lossed out trades. You definitely don't want that. So I would say that in general, I disagree with this statement. Having said that, sounds like these people might be more active traders, so maybe it doesn't apply to me. But yeah, you don't want to cut off your trades the moment they stop working. Plenty of iron condors, straddles, butterflies, they're down 10, 20, 30% of the premium collected, and then they will eventually go on to make money. So like I said, 50% is the ideal number for me. That's just what I've found. Many, many years of experience. After 15 years of testing everything, that's the ideal number. All right, Alexander. Are there any overall portfolio metrics that you monitor, such as portfolio Greeks, correlation, and beta? Yes and no. Let's take them individually. So Greeks, in general, no. What you're saying is we don't have a whole lot of trades open right now. We've basically only got the Dow, the Qs, the NASDAQ, and then one Iron Condor. So we've got a couple of strategies that are sitting in cash right now. We've got this one, which is in cash. We've got this one, which is in cash. And then this one only has one position on. So I can't use a completely good example, but what you're saying is, yeah, technically speaking, if you wanted to manage a portfolio with the overall Greeks, I can see the overall delta of my entire portfolio, 579. So this means that if the stock market, the S&P 500 goes up 1 point, then my portfolio will make $579. I could manage my portfolio as a whole. I could delta hedge it, for example, and make it 0. Right now I've got positive delta, so I could take on some negative delta until this number is down to 0 or close to it. I could gamma hedge, I could theta hedge. Whatever you wanted to do, excuse me, you can do that. But what I prefer to do is I trade all 5 of our strategies independent of one another. So you can see this is the portfolio. I don't do anything in this strategy based on anything that's going on in this one. It is totally independent. When it hits these levels and these thresholds, we are going to be in that position. We're going to be either in bonds, which is the VGLT, 20-year treasuries. The QLD is 2 times NASDAQ. The XLU is a utilities ETF. And then when the market's really crashing, we're going to be in cash. This strategy trades no matter what based on those signals, not influenced at all by the balance, the strategic, the broken wing butterflies on the UVXY. Likewise, I don't do anything in the Iron Condor strategy that I wouldn't have otherwise done if something else. Everything is independent. So for the first one, Greeks, of course you can do that. It's actually very easy, and trading softwares will do that for you in a heartbeat. Like I said, whatever you want to do. Let's say I didn't want to be Vega negative right now. Let's say I thought volatility was kind of at a low range and it might spike. Well, in that case, I wouldn't want to be Vega negative. Maybe I would get take on some positive vega, sure, you could do that. But for me personally, no. Portfolio-wide Greeks, I don't care about that at all. Correlation, though, that's completely opposite. Yes, correlation is super important. Of course, that's the major part of my risk management here, is to make sure that I'm not in any positions that puts my entire portfolio exposed to the same market environment. You don't want to be in a situation like most investors, unfortunately. This is something they always kind of learn the hard way, is that correlations tend to approach 1 in a crisis. And when we say 1, correlation goes between -1 and +1. So a correlation of 1 means that it's very directionally strong compared to the underlying market. A lot of people learn that they've got this complicated pie chart, and it looks like they've got private equity, and they've got hedge funds and real estate, and they've got all these things in their portfolio, and then the market crashes, and all of those assets actually are highly correlated to the stock market, and then your whole portfolio crashes. So I have to make sure that my correlations between all of my individual strategies are not to the point where I'm overly exposed to anything. This is one of the major aspects of my risk management personally. So I can kind of show you our correlation matrix down here. All of our strategies, they actually show pretty low correlations with each other, especially when you're talking about options, negative correlation here. But our strategic leverage, our strategic tail risk is only 20% correlated to the defensive rotation. When you're talking about correlations, like hedge funds are over 90% to the stock market. Even the V-Banks, which has 40% bonds, it's 90% correlated to the stock market. So I like to have my strategies that are actually fairly low correlations. 23, 20, 52, that's pretty high. So strategic and tactical balanced is probably the highest correlation we have. But then we've got a -5, a 6. I can basically make sure that, yes, I definitely go through periods with my portfolio that it goes down and I lose money. I have losing years from time to time. But I do want to make sure that the correlation isn't so strong that I'm going to just get blown up when the market goes down. I don't want to be correlated to the stock market. Essentially, I want to keep it sort of low 20s and 30s, which it's not easy to do. Most people's portfolio, when they actually run the numbers, would be roughly 80 to 90% correlated with the stock market, which is, of course, not good. Bull markets, you're happy. Bear markets, you're upset. I mean, who can't do that? That's not even really investing, is it? There's no skill involved in just being long the stock market and just crossing your fingers. So yes, correlations is quite a massive part of what I do. And then the last one, you said portfolio beta. For people who don't know what beta means, beta is essentially measuring the magnitude and direction of market exposure compared to something else. So I do actually, in every daily email, I tell people our entire portfolio beta compared to the S&P 500, updated every day. So right now we have a portfolio beta in the leveraged portfolio of 0.84 to the S&P 500. This means, now it's not a direct mathematical line, but it is direction and magnitude. If the stock market goes up, say 1%, all other things being equal, my portfolio will probably go up 0.84%. Now, again, day to day, you're going to be seeing differences here. This is not a mathematical, direct linear, correlation, but you get the point. But my portfolio beta can actually go from, say, as high as 1.4. Sometimes we're leveraged more than the stock market in really good times. Like if I'm in the double NASDAQ, the double Dow Jones, the double S&P, I've got 2 UVXY broken wing butterflies going. I've got 2 Iron Condors going. We can actually see a portfolio beta that hits over 1. But during bad times in the market, when my volatility barometer goes into the extreme levels over here, and we've got no reason to be in aggressive market positions, and we've got no reason to be short volatility, at that point, I can be in utilities or cash. I can be in cash or gold. I can be in cash or long volatility. And at that point, my portfolio beta can actually go to about minus 0.5. So again, we have an active trading portfolio that has a very large range of beta. So I would say for the first one, Greeks, not important for me. Correlation and beta is a major part of what I do. And it's essentially my risk management is done by correlation, beta, and position sizing. That's essentially how we manage our risk. We don't directly hedge. because we try to manage everything else with correlations and beta. So that's an awesome question. Thank you for that one. Hopefully I touched on it. Bruce, you're fantastic. Thank you. Wow, that's all bold. Fantastic. Thank you. Your fantastic 3-year-old video on the VTS barometer shows performance with you flat VX if the VTS barometer is over 50%. This leaves a lot of money on the table like recently. Have you tested short VX performance with higher signals such as 60, 65, 70? So that's a super good question. Yes, so if anybody is interested, this is going to autoplay a video probably. Let's go to the Volatility Barometer on the main channel. And what he's essentially talking about in this video, I used my Volatility Barometer, which is, sorry for all the scrolling, but it is what it is, my Volatility Barometer here, and I wanted to make a video explaining how it works and giving a real world example. So what I ended up doing was using a 50% threshold, and I basically showed that if you use my Volatility Barometer, shorting volatility, shorting the VXX, only when it's in the 50% or below level, and then 50% or above, you're going to be in cash. These are the results. It would have been a strategy up 1,500%. If you would have used the VIX doing the exact same thing, low VIX being the bottom 50%, high VIX in cash being above 50%, the VIX didn't even beat the S&P 500. And then the S&P, of course, is all the way down here. So I wanted to demonstrate that the volatility barometer is actually an extremely robust indicator, essentially 1,500% better than using the VIX index. This is why I say, like, my work is based on all of my volatility metrics, and the volatility barometer is an exceptional measure of volatility. But what I wanted to say for your question is, and that's really, really good that you've noticed that 60, 65, maybe even 70 would be better. You're not wrong. When I made this video, I don't actually use 50% for anything in my own trading. I just needed an example for the video that didn't seem like I was cherry picking. I didn't want to say 63%. Somebody would, in the comment section would say, oh, 63, really? Why would you use 63? You're cherry picking. So I just wanted to use something that everybody at a glance would accept as, this is not cherry picked in any way, shape, or form. It is literally half the signals you're going to be short vol and the other half you're going to be cash. But like I said, very astute of you to notice that probably 60 to 65 is the more ideal number, and you would get numbers performance even better than I showed. But it might sound like cherry picking, so that's why I did it in the video. But yeah, you're right. For my personal work, no, I don't use 50% at all. We are typically in what I consider either long equities or short vol, probably about 60% of the time, sometimes even about 65% with this strategy. And then here as well. We don't use 50%. You're right, that does leave a little bit too much on the table. Now, if you go as high as 70, 70 is going to lead to pretty large drawdowns, but the terminal result, terminal meaning if you just did something, traded it, came back 10 years later and you actually didn't have the roller coaster of emotions through drawdowns, just the terminal results, probably 70 would be even better. But I don't think the average investor can sustain drawdowns much larger than, once it starts to get about 30%, they tend to start looking for the exit. So you definitely want to avoid drawdowns that are too large. And if you're short vol or long double equities 70% of the time, you're going to have some pretty excruciating drawdowns. So I would definitely, even though the terminal results might be a little bit lower, 60% is probably a much more accurate number. It's going to allow the most number of people. There's still going to be drawdowns. Investing is investing, and it's still painful sometimes. But you don't want to get too high. You don't want to allow drawdowns to get into the 35, 40% range. At that point, most people are going to pull the plug. So very, very good that you've noticed that 60 is actually better than 50. I didn't mean to deceive anyone. It was actually for the exact reason I didn't want to seem like I was deceiving. I just chose 50 for a video, and I made this video. But yeah, good call there. 60 is better. 63 is probably, if you gun to my head, if you made me pick a number, 63, that's a good one. All right, last question. Can we get the historical VTS barometer data? For this one, just email me. Now, I will mention again that for the upcoming VTS options course, I've got too many spreadsheets. I'm going to get something's going to crash here. But for the VTS options course, you're going to get everything. You're going to get the volatility barometer going back as far, it's all the way back to inception, which is 2011. But you're also going to get all the VIX futures data, all the cash VIX data for the various time frames of the VIX, all the, the volatility indexes that all the volatility ETFs are based on. You're going to get all the volatility ETFs back tested all the way back to inception, talking about going back all the way to 2005. I've back tested them all. And you're going to get all of this data with the course. So if you want something specific, let me try to close some of these down. If you're trying to get something specific, like say just a few years, just email me. I'll just send you a spreadsheet with just the volatility barometer data for a few years, and you can backtest away. Ask me questions, what it all means, that's fine. Of course, I can't give you the actual calculation of it, but I can certainly, as you've noticed, I'm pretty generous with my time. I'm pretty generous helping people trade. There are a lot of people that pay me for my signals, but you don't necessarily have to. You can kind of join VTS some people join for 6 months or a year. They learn everything they can. They absorb all the information. And then maybe a year later, they're going to go off on their own and trade their own portfolio. That's fine too. I've got a lot of people who they've got day jobs and families, and they just have no time to manage portfolios. Those people are going to stick with me for 20 years. But there are people who are just passing through to learn as much as they can for a year or two, and then they're going to move on. So if you're one of those people, absolutely great. I do not mind at all. And I will help you as much as I can. So, all right. My throat today. I was out running, and it's actually cold in Dubai. People think, I thought as well, it must be just hot all the time. It's actually cold. Pretty chilly here, and it was raining. It only rains a couple days a year, and it's rained 2 days in a row here, which is, I feel like I won the lottery. All right. But I probably should have taken some cough lozenge or something. Okay, so I do see the Clips channel. Make sure that you, in the comment section, just go to the Clips channel and subscribe. We've also got the newsletter. I've got a totally free newsletter. You just sign up. You'll be notified of any articles, videos. A lot of the articles that I do, of course, because it's an article, it's not on YouTube, people miss them all the time. So you definitely want to join the newsletter. There's quite a lot of content that I will put on the free newsletter, and you're definitely going to want to sign up for that. So go ahead and do that. Vicus, sorry, pronunciation's probably bad, but thank you. The echo, it's crazy for me. In my ears, it's just ringing, but okay, no pool party. This is referring to the last couple of weeks I was in a different hotel. I'm in an Airbnb now. There was a pool party right outside my window for the last few live streams, which was tempting. Who wants to sit here on a volatility stream when there's a pool party going on outside? I'm in Dubai right now. I was in Switzerland end of August to early October. We took a long trip to Switzerland, did the train system around the whole country. We stopped in about 10 different cities. It was a great trip of a lifetime. But no, we're back. We've been back for a while. I'm in Dubai now. Okay. This is interesting. How do you notice that one of your strategies isn't working anymore? Do you have thresholds like success rates for taking a strategy on board or removing it? So this is a really good question. I showed before that we currently have a portfolio made up of 5 strategies with 20% allocation each. But if, there are people who have actually been following VTS since it launched the first day, still got some of those old OGs following me. And so they are going to know when I say this that these are not the only strategies we have. This is just what our current portfolio in 2023 looks like. But, excuse me, we've had different ones. We've had one of our flagship strategies that's been in the portfolio for 10 years. It was just removed in the last 1 year, tactical volatility, which is our main volatility strategy. The reason that was removed, it wasn't really removed because of performance. It was removed because right now in this current market, and this gets to the heart of your question, right now in this current market, volatility is actually punishing people for being short vol pretty often. In the last couple of years, we've seen a lot of volatility spikes, and we've seen very few really long, drawn-out trends. Like what we've seen in the last 2 to 3 months, This hasn't come around in a long time. If you've seen the volatility ETFs recently, they've just cratered, right? But for a while, it wasn't like that. Like for a whole year, it was kind of doing this. And now just recently, in the last couple of months, it's really, the bottom has fallen out and it's dropping. But volatility strategies no longer get that really good bang for your buck because there's been a lot of volatility spikes and very few longer term trends. So I have defaulted to 2 times equity ETFs instead of short vol for the last, say, 1 year. But for the first 10 years, we were using short volatility quite a bit in the portfolio. That one was removed. I have to make these decisions. Where's your question? We've done these. I'm going to close that. Your question was, how do I know that something is broken? Well, of course, this is a judgment call. It's always going to be a judgment call on my part whether a strategy that I'm trading is just going through a bad period or whether it's really broken or maybe just not suitable for this current environment. And that's the case with tactical volatility. Got another one called Breakpoint that was really heavy in the portfolio early on, the first 4 or 5 years, and now it's no longer in the portfolio because it was using bonds a lot. And it's just not a great environment for a bond strategy, so that was removed maybe 7 years ago. Maybe it'll come back someday, maybe it won't, I don't know. We've got aggressive vol. That was another volatility strategy that was removed in favor of 2 times NASDAQ. It just functions better. So typically what I do, because overfitting, curve fitting, is a massive problem in the trading space. You've got a strategy, everything goes through periods where it's not working. You will never have a strategy that just crushes it in all markets. It's impossible. So it's a real fine line between recognizing that something is just temporarily not working versus something that fundamentally has changed in the market and it's not working anymore. That's a difficult thing to do. So I try to hold myself to about a once annual audit of everything that I've done the previous year, typically in December or January, and I make my decisions. So this year, as the calendar year rolled over from 2022 to 2023, and this is interesting, is because 2022 was actually my lowest performing year ever that I've been trading. And I did not make any changes to my portfolio. The portfolio that I currently have now, 5 strategies at 20%, this is exactly what it was last year in 2022. We have not made, as that December, January rolled over, I did not make any changes because I had to make a real assessment. What happened in 2022? Is it my strategies are broken or was it just an outlier in the market? I ran all my numbers. I did my audit. I tried to be as brutally honest with myself as possible. You want to remove your ego from the equation and really just dive into the numbers. And I have honestly assessed that 2022 was just an outlier year. It was just one of those years where stocks were down, 19%, bonds were down 32%, utilities were down, gold was down, everything. It just was an outlier year. You do not want to optimize strategies for an outlier. So I didn't go through and change everything. But in 2019 to 2020, for example, I did make some changes at the end of the year. At the end of 2020, I made some changes. Great question. Unfortunately, the answer that I can give you is it's just as much art as it is numbers because you're going to be faced with the reality that we can't see the future. And so I have to make an honest assessment. And like I said, try to get your ego out of it because everybody thinks their strategies are awesome. You have to be able to be honest with yourself and say, no, I've either made a mistake or I'm doing something it's just not working anymore. And that's fine. It's tough. Sometimes it's tough. I've made mistakes in the past of not removing something and it just kind of performed worse for another year and then eventually you remove it. And I've also done the opposite. I've removed strategies that almost immediately started doing well again. So nothing in the trading world is ever 100%. It's like batting, batting 300 is considered really good in baseball. Hopefully we do better than 30% success rate, but you can't win them all. I've made mistakes on both sides. But in general, because I crunch numbers and calculate and consider so much, and I really am quite good at removing my ego from the equation, I rarely make that mistake anymore. So hopefully I answered that. Here's one. February 21 and 22 has high risk on VIX exploding. Why? Oh, because the FY closing in March in Asian countries. Do you have anything you know? I never take things like this into consideration. I've got a video on the YouTube channel called the double uncertainty principle. I don't even know if this is a thing. Maybe I just made it up myself. But the thing that you'll notice if you start paying attention to some of these dates that you fear, like, oh, you better look out for February 21st, what you find is, first of all, we don't know what's actually going to happen. So that's the first uncertainty, is that whatever you think is going to happen on February 21st, we don't even know if that's going to happen. The second level of uncertainty, why I call it the double uncertainty, is even if I knew with perfect clairvoyance of the future on February 21st, this is going to happen, this sequence of events, this market announcement, this level the Fed is going to do, this election is going to go to that person guaranteed. I know 100%. I still don't know how the market's going to react to that news. So I used the presidential election to illustrate my double uncertainty principle, where, first of all, you don't know who's going to get elected. So that's the first level. Even if I knew, somebody told me 3 months in advance, Donald Trump's going to get elected. Okay, I still don't know how the market's going to react to that. If you remember back when it was like the Hillary Clinton election, everybody thought, oh, it's just it's a foregone conclusion. If Hillary Clinton gets elected, the markets will do this. If Donald Trump gets elected, the markets do that. And it turns out not to be the case. It's the same with Fed announcements. We don't know what the Fed's going to do. We don't know if it's going to be a 0.5, a 0.75. And even if we do, we don't know how the market's going to take it. An earnings announcement. Is it going to be good or is it going to be bad? First level of uncertainty is you have no idea. The second level is sometimes when the earnings are good, the stock sells off. Sometimes when the earnings are good, the market skyrockets. Sometimes the opposite is true. Earnings are terrible and the stock rallies. You're like, well, that doesn't make any sense. We don't know. You never know. So it is really a futile endeavor to try to look at these forward uncertain events and try to structure your portfolio around it. For every time that you did it right, like let's say I think, oh man, that volatility is going to spike on February 21st. For every time that I'm right, I'm going to be wrong as well. I'm going to have jockeyed my entire portfolio for this impending doom and nothing happens. It's just a regular Tuesday. You know, that happens a lot as well. So long story short, whatever you're talking about here, I would never take it into consideration. I would just, the day of, the day before, the week of, I am just going to get my data. I'm going to input in my spreadsheet. I'm going to crunch all the numbers, and whatever the trade spits out at me, that's what I'm going to do. I'm not going to say, oh, you know, I'm not going to go into this stocks because that, you know, that Asian thing you're talking about is happening on the 21st. I better just stay in cash. No, if it ticks over, I'm going to take that trade. That's just what we're going to do. I've been doing this for so many years. I know that for every time you move everything around based on an emotional decision and get it right, you're going to get just as many of them wrong. So just be cold hard numbers. At any opportunity you have to not take macro into consideration, you should do that, because macro events are the most uncertain, unpredictable, total letdowns most of the time. It's just not worth it. So, all right, Tim, when long vol in the right moment with some long calls on the VXX, is it possible for your POV to get out of the position in a big spike up like Corona with acceptable pricing? Position? I think what you're asking is, let's say you're in a position, you're in long VXX calls, and you get, like you said, the COVID thing, and prices are moving so fast, you're wondering if you're able to get out of them. There's always going to be slippage the faster the market's moving, and that's true if it's going up or down. It's the same thing. With options, one of the rules, I have a video coming out that's 10 universal option trading laws. One of those rules is try whenever possible not to execute trades during fast moving markets, because you're just going to have some slippage there between the bid and the ask. You have to understand that options are provided for based on market makers doing the best they can, but these are not totally flawless. They're not infinite liquidity. So there is always going to be inefficiencies involved. So if you are in a long VXX position, you might have even benefited from that slippage, because Volpocalypse, for example, one of the reasons that it got so bad was because there was so much buying into those long VIX futures positions. Maybe you would have benefited from that squeeze, but if possible, wait for a little lull in the market or wait for some calm and then try to get out. If you can't, if you really can't do anything and you're in a position that you have to act right now, then of course, just do the best you can. Always use limit orders. Don't ever use market orders for options. Calm market, fast market, whatever it is, don't ever use market orders for options. That's one rule. But if you're using limit orders and you do the best you can and you use the 30-second rule like I teach people, enter a price that you think is pretty good, better than the mid, wait 30 seconds, drop it a penny, wait 30 seconds, move it a penny, wait 30 seconds. You should be fine. It's just the best you can do in the moment. None of us can do any better than that. Is this a different question? Would you say that option pricing on VXX options, broken wing butterflies, are always reasonable with the underlying? I did back tests and have concerns. Do you have any more questions? Okay, that's it. Yeah. I mean, the options on VXX are not the VXX. So if that's your question, no, you shouldn't be expecting it just tick for tick to be moving in the same way. Options are an independent market. So if that's your question, but if you mean like you're having difficulty getting execution prices for broken wing butterflies, did you have problems 4 months ago? Because lately, with the prices going so low, especially on UVXY, it's down in the 4s now. They haven't reverse split yet. I don't even think they've announced it yet. It's at 481. Now you can start to see, if you're looking at the option string, yeah, like if you're in this trade and you're doing a broken wing butterfly, you don't have a whole lot of strikes to choose from here. So as the price is going extremely low, of course, it makes no difference at all for the value of things. The options are still the same value. The ETF's still the same value. Everything's the same, whether it's $4 or $50. It doesn't matter. But with respect to options, you're doing 3 strikes in a broken wing butterfly. Probably one of them is going to be a lower volume, lower liquidity strike. So that's why I ask you, are you talking about just in general on all broken wing butterflies or just in the last month when it's really bottom has fallen out? I have also noticed that pricing has become difficult. If you notice something, there's no reason really why we would be in cash here other than I'm not seeing any trades that jump out at me lately. I'm just, for the last couple of weeks, every time I try to input a trade, it just doesn't seem to be the right risk-reward profile. And a lot of that probably has to do with the fact that the UVXY has dropped so low. So even using the VXX, what am I looking at here? VXX at 11, it's still the same thing. I scouted out a trade that we might do next week if conditions hold. But yeah, overall, you're not wrong. Lately, it's been a little bit challenging, but I don't think that's a long-term thing. Like, I've never had any trouble, and I've been doing this for so many years. It's fine. You just execute, use the 30-second rule, do the best you can with limit orders. That's your trade. You just get the best you can. If it's a good trade in the moment, do it. If it's not, then you don't. Okay, next question. If you change your strategies to make them better, do you show us the improved historical performance or the actual historical performance? Okay, good question again. I like this. So everything you see, and this is an important distinction with my work compared to, unfortunately, pretty much everything else you'll see out there. All performance that I show for my portfolio is the actual performance of only the live emails that went out to subscribers. So I've got my portfolio here. Let me show you with a little quick example here. I've got the portfolio here. This is what it is right now. And I report performance. I'm a few weeks behind, but every month I'll post it up on the website. Let's say, for example, that I've decided I'm going to remove defensive rotation. And then I'm going to go 25, 25, 25, 25. What I won't do is go back into the performance record, update everything for 25%, and then show people that. You will never see that change on your end. That will only be marked forward from the day that I make the change. So even if I were to do that, the performance going backwards has never been changed. That is literally every email signal that went out to a paying subscriber. No matter what changes I make now, I will never go back in the past. So essentially what this is called is survivorship bias. Survivorship bias is a very big problem in the financial industry, where if you remove something or if you change something, what they tend to do is show you what it would look like now. So if I make those changes, let's say I improve things and I adjust those ratios and it turns out that 5 at 20% isn't the ideal. It turns out that 4 at 25 is way better. I can't just show you 4 at 25 on the website because that didn't go out to a real person. That's just me behind the scenes changing the numbers. Anybody can do that, and pretty much everybody does do that. That's how you see these long-term track records from people. It looks impressive. It's not real. They're using survivorship bias. It's the same thing as indexes. It's the same thing as mutual funds. When you remove something, they just remove it. It's just gone. And then from that day forward, they adjust everything going backwards and it looks awesome. Looks like it was never there, right? But it was there. And real clients actually took those trades that you just removed from your portfolio. That's not fair at all. The other thing that they will often do is called backfill bias. It's another really big problem. So again, let me show you an example. I have 5 strategies now. Let's say that I launch a new strategy, okay? Starting tomorrow, there is now a new strategy and my allocations are shortened. And it turns out the new strategy is a short vol strategy that makes 40% a year. So it's going to make my portfolio look better. What I can't do is plug it into the portfolio, adjust all the numbers going back to 2012, and show you, look how awesome my portfolio would have been. That's backfill bias. You're backfilling something that showed up in 2023, and I'm showing my clients, oh, look how good it would have been if you happened to have done this in 2012. The point is, you didn't do that in 2012. So why show it? This is a massive problem in the financial industry. Survivorship bias, backfill bias, it's crazy. And Twitter is, don't even get me started on all the fake trading gurus out there that are showing you these incredible track records that all they're doing is changing the names of things and changing the allocations of things and trying to make it look better. My performance is never adjusted going one day backwards. That record, that's what real clients got. If I make changes going forward, awesome. I'm trying to make my portfolio better all the time. That's true. But the new record will only show based on today going forward, if that makes sense to you. So no, if I come up with some type of change that I think is better, you will never see it on the website. It will never show up. The only way you would ever know that is if I actually told you starting on this day. You're not going to show up one day and be like, oh, I thought I saw somewhere in 2015 you had a drawdown, but the drawdown's gone now. And I come back and I say, oh, that's because the short vol strategy was so good that it plugged in that hole, and now that drawdown's not there anymore. What do you mean it's not there anymore? I had clients in 2015. They saw that drawdown. They got the email. They took the trades. Of course I have to show that drawdown. I can't just backfill it out of there. I could come back tomorrow and I could show you an incredible track record, totally Bernie Madoff. But, that's what the financial industry does. I don't do that. I don't play those games with my clients. What you see is exactly the record for the last 11 years of every live email that went out to a real person, a paying client. That's it. I don't show anything else. So I love this question for the reasons that I can actually point out that I'm actually doing what you would hope that most people do. The unfortunate reality in this world is this is a rampant problem, both with unregistered Twitter loser gurus, but also with registered advisors, with funds, with hedge funds, with mutual funds, with all of these things. Backfill and survivorship are a huge problem, and it can really deceive the long-term performance. You might be looking at something that looks great, and the real clients that traded it 6 years ago, it was nothing like that. It might have been a nightmare. They might have lost 40%, but you can just remove that and keep going. And technically speaking, regulations-wise, there are ways to hide that from people. So no, long story short, everything you see in my performance is exactly how it played out in real time for everybody. So unfortunately, it's just one of those personal victories because nobody cares, nobody knows this, everybody assumes you're a cheat and a liar anyway. So it's just one of those personal pride things that I know for me, I've never done any of these stupid games that people play. And I can always be proud of my track record, even though I do have a losing year. Like last year I was down and it's going to show up on the website. No matter what I'm trading in 2025, that drawdown in 2022 will never be removed. That was paying clients that suffered that drawdown. It's there forever. In 2045, you can come back and look at my track record. That drawdown will still be there. So it is what it is. When will you return to bonds? As soon as the Fed makes it clear that they will be cutting interest rates again, then we can start initiating some of these positions. Now for defensive, this bond, it was never removed because we're never going to flash below 25%. It's going to be a number of years before we get to really, really low vol levels again. But this cash, it'll go back to 7 to 10 year US Treasuries. And this cash will go back to probably real estate, the IYR ETF. But in the past, even this one was TLT, which, if the Fed was aggressively cutting rates, TLT would be a great position to stuff back in there. Probably from 2012 to about 2018-ish, 2019 maybe, we were using TLT in that position. And as soon as the Fed signals that it's done, they're going to do the long-awaited pivot, then we are going to pivot right with them. Remember, there's an inverse relationship between bond fund performance and interest rates. Right now, interest rates are going up. The TLT was down 32% last year. Terrible, though, so we didn't use it. We removed it. That will change. At some point, the Fed's going to have to pivot. So, Bruce, yeah, you had the question about the volatility barometer. I have my own short vol system, but your VTS score is very helpful for me. Yeah, hopefully. I think you might fall into the category of some of the people that essentially there's three ways people use VTS, right? The first one, which I touched on, investing is really, really hard. And there's a lot of people who simply don't have the time to do it themselves. So they want to trust somebody who seems honest. And hopefully that's me. If it is, great. If it's not, do your due diligence and find someone else. But there's one group of people that just follow everything I do no matter what. Second group of people would be, maybe it sounds like you. You have your own systems, but you also use me as sort of a check. Like I'm a fairly conservative person and I need a green light to really take something, and I don't do anything emotional and I don't do any personal predictions like that. So I am a pretty good person to have that secondary signal just to check to make sure. Sounds like you're in that second group. And then the third group would just be people who join my service and just try to absorb everything they can so that 6 months or a year later they can leave and do it themselves. Sounds like you might be in the second group, where having me to double check things is, just to peek over your shoulder and say, maybe now's not the time. So however people use my service, it's fine with me. I provide everything and I help everybody as much as I can. Okay, many thanks for your content. No problem. Do you work some strategy to play earnings? Yes. If so, could you give us some advice on trade earnings? How long? Okay. Remember at the beginning of this live stream, I told you to subscribe to the Clips channel. Let's go to our good old Clips channel. And I actually did something very recently that you might be interested in. Earnings season. This clip right here. Watch this 4 minutes and 18-second clip. I basically told you how to trade earnings in 4 minutes. You're going to want to take that. You're going to want to watch that clip. But essentially what I explained there is that with earnings season, if volatility is relatively low, which it is now, I mean, you might think, oh, a VIX of 18, that's pretty high. It's actually low relative to where it's been in the last year. So we're in a low band of relative volatility. I never look at the nominal levels. I only look at relative levels. And so if volatility is low, you certainly don't want to be selling options into earnings season. So you can actually buy long straddles, maybe long calendars, about 10 days in advance, and you would be closing the trade the day of earnings or the day before earnings. Don't let it go through earnings because then the volatility will come down. But watch that 4-minute video. I think you'll learn a lot. And then, of course, next week, ask follow-up questions. I'll expand on it further if you have more questions, but I think that'll answer quite a bit, actually. Please describe some good situations for shorting Iron Condor and Butterfly. So Iron Condors and Butterflies are essentially the opposite trade. And what I mean by that, for anybody who's signed up for the VTS service, I don't like to use my live streams as like a plug or anything. So hopefully I'm not saying that too often. But we have an Iron Condor course, many videos about Iron Condor specifically and members of VTS. So you can sign up for a free trial, 2-week free trial, and you can absorb the entire course. You can watch all the videos. And then if you want, wink, wink, you can actually unsubscribe before the 2-week trial. And if you forget, like if you miss it on the date, it's fine. I refund everything, no questions asked. So, don't worry like, oh, if I forget, I owe them $100. It's fine. I'll just refund the money. But you can go ahead and check the Iron Condors course, and in there you'll learn a lot more than I can tell you in a live stream. So I would suggest anybody who has Iron Condor questions, you do want to go on the website, take your free trial, and then at the end of the 2 weeks, I'll leave it up to you whether you stick around for a little while or not. But that's what you want to do. Essentially, Iron Condors are best sold when volatility is mid to high because they're a short Vega trade that profits when volatility declines. So you don't want to open an Iron Condor when the market's super stable with low volatility because there's nowhere for volatility to go but up, right? You'd be walking into a headwind. Calendars, on the other hand, especially long-dated calendars like we trade, 45 to 75 days in advance, these are long Vega. They benefit from increases in volatility. So those are best suited when volatility is low. They're both delta neutral positions, but one of them is better for mid to high vol, Iron Condor, and one of them's better for low vol, calendar. So you can learn that plus way more, stop losses, position sizing, rules of engagement, all of that. Just take the free trial and then absorb that Iron Condor course. I'm sure I will answer all your questions in it. And if I didn't, shoot me an email and say, hey, you missed this, make a video on this, and I can make a video and stuff it into the course for you. If UVXY is below 5, why would we do options? We can buy the ETF. Uh-oh. Sounds like you don't fully understand what I meant by none of the value actually matters. The UVXY at $5, and this is a really tough thing for people to understand when they first start trading these products, but the price of the ETF itself, you just have to take my word for it until you learn more, but it is completely irrelevant. So a UVXY price of $5 means the exact same thing as a UVXY price of $100. Exactly the same thing. The UVXY tracks essentially an index called the SPVX STR index. It's tracking the front 2 months of the VIX futures. And that is all it is doing. It is tracking this with 1.5 times leverage, the front 2 months of the futures. The price of the product is totally irrelevant. So if the VXX or the UVXY was your question, if it goes up, if this VX30, these front 2 month futures, let's say they go up 3%, and that's going to cause the UVXY to go up 4.5%. If the UVXY is at 5, it's going to go up 4.5%, and it's going to adjust the price based on $5. If it's at 100, it's going to go to 104.50. It's going to go up the exact same 4.5%. The actual price makes no difference. So your question here, if the price is low, why not just buy the ETF? It sounds like you're thinking about it in terms of a stock that's a very low price right now, that, oh, I can just buy it and it can go up maybe. It's not. UVXY can go to 3 cents and it's not cheap. It can go to 100 and it's not expensive. It's the exact same thing. It does not matter. The only practical application we're talking about is it does tend to have an effect on the options, right? So if you have a stock that's, or an ETF, I shouldn't even say the word stock. If you have it really low and you're trading an Iron Condor, for example, which is 4 legs, it's pretty difficult to get liquidity from 6, 550, 5, 450 down to 4. Maybe you're doing a broken wing butterfly and you need a 350 strike. There's not going to be any volume there. So they should reverse split it simply to help out the options people. So the market makers can create new option strings around, like, say, a $50. And then broken wing butterfly at 45, 50, 55 is way easier to execute than it would be in the 5s and the 4s. But don't make that mistake to think that the UVXY is cheap right now. It's totally, totally irrelevant. You have to understand that it is tracking the VIX futures, and it is tracking an actual index, which people oftentimes don't realize, but it is tracking this index. The UVXY itself, the NAV value will just do whatever this short-term VIX futures index does. That's the UVXY, but the UVXY is 1.5 times leverage. So it's just this index times 1.5. Does not matter if it's $50, $500, $10,000. It's going to go up the same 4.5%. Doesn't matter. So hopefully I explained that. It's not a stock. It's not cheap. It's not expensive. It's just tracking an index. It's just a number. It's just a statistic, basically. Don't look at it as a price. Don't look at it as a stock. It's none of those things. Just a statistical representation of what the VIX futures are doing day to day. That's all that the ETFs are. I know it's tough for people to wrap their heads around because that's not the same for anything else. When you see an ETF, you think, well, that's a stock and it's cheap, right? If the XLU goes down to $5, you'd be like, let's buy that. That's so cheap, right? No, volatility ETFs don't play that game. Another VTS options question. I hate even saying a date because then I'm gonna disappoint probably. It's way more work than I thought it was, given how much I already work. I can only really find a couple hours a day to dedicate to it. So a couple months, sorry. This is a late question. We've already answered it. Does your service work in an IRA? Yes, 100%. Just for the benefit of anybody coming in super late. Yes, our portfolio, all 5 of our strategies can be traded within an IRA. None of them require a margin account. They can all be done in cash accounts. So any broker should be able to do it. It's possible you'll get brokers who won't let you do an Iron Condor, for example, in an IRA, but it is allowed. And there's plenty of brokers that know that, and it's a defined risk trade. It doesn't require margin. And you can do that in IRAs as well. You can trade Iron Condors in IRAs. I don't know if you'd have to shop around, but I tend to think most brokers these days, they understand that. All right, well, again, we didn't do the mailbag, so I have to do this for the VTS community. I have to cover what I wanted to cover today. So let's do the email question that I got, because I have to include it. I have to let my community know how to deal with stop losses and talk about performance. So let's go ahead and do the segment now, and hopefully people learn a little bit about stop losses.
Welcome, you've got mail.
Okay, so what I wanted to talk about briefly, the mailbag is essentially me just answering an email that I got publicly that I think people might benefit from hearing the answer. So this person asked me on January 19th, I got an email. So that was last week. This person asked, I was in the same QQQ Iron Condor as you, but mine crossed my 50% stop gain yesterday, so I closed it January 19th. Why didn't you close the trade for profit? So what this person is saying, and this is why those labels were marked when you saw it earlier, is on the Qs, I entered an Iron Condor on the Qs on this date, and I exited it as a stop loss on this date. It actually lost money. So I think in the last, say 10 trades, I think 2 of them have lost money, 8 of them made money. This was one of them that lost. This person emailed me on this day and actually said that his trade crossed the 50% stop loss and he exited for his profit. So he made his money. I went ahead and left mine open and my trade lost money. So we're in a difference here where he made his profit and I lost my profit. This is a pretty big discrepancy for a single trade. Why didn't I close mine? Well, the trade in question is this one. So this is a QQQ Iron Condor that I sent out December 21st, I believe, is when we opened it. And on his date, his trade was profitable. Mine wasn't quite. So essentially, I sold my Iron Condor for $1.25. That makes my 50% stop loss half of $1.25, which is $62.50, round up to 63 cents. So if this Q's Iron Condor, the premium dropped down from $1.25 where I sold it down to 63, that's my stop gain, and I'm going to take my profit, right? His apparently crossed, but the day of this email that I got, the trade was actually only at 66. That's the best price that I saw. I didn't see 63. But that's the thing with intraday trading is I got $1.25, but maybe he got $1.30. And maybe I didn't look on it every minute for the whole 6 hours. So I saw 66 cents. Maybe it went to 65. So if his $1.30, maybe he stop gained out. Essentially what I'm saying is intraday pricing is going to be a little different for everybody. We all get into our trades at a different time of day, and we all exit our trades at a different time of day. So it's never going to match up exactly. This is one of those situations where he got his profit, lucky for him, and I ended up taking a loss. But essentially, the reason I have to show this to the VTS community is there's two ways you can approach this, and they're both equally viable. The first way is that you can just follow my trade signals as they come. So you will open and close your trades on the same days that I do, no matter what pricing you see throughout the day. So if yours was 65 and you opened it for $1.30, technically that's your stop gain, but I didn't close my trade, so you shouldn't either. You can do that. You can just follow my trades exactly. So when I'm sending out these emails, here's the Iron Condor strategy. If you see no new trade, then you do nothing. Even if yours hit the stop gain or stop loss, it's only going to be a couple of pennies and it really doesn't matter long term. I don't mean to be callous or cold about it, but it's not really going to matter. The other thing that you can do, and again, like I said, this is equally viable, you can go ahead and follow your own risk management for the trades that you put on. So on December 21st-ish, we opened an Iron Condor and I sent out the signal to my community. So you got in the trade as well. From that moment, you can either open and close it exactly like I do, no matter what happens, or you can just know that because you've watched the Iron Condor course, you know what the 50% stops are, gain and loss. Anybody can just take their premium, divide by 2, or take their premium and multiply by 1.5, right? Anybody can do that. So if you want to follow your own Iron Condor stop loss or stop gain, go ahead and do that as well. And in this case, maybe you would have stop gained out and you would have made your profit. It's really not going to matter. What am I looking for here? So that's the second thing that you can do. You can basically use my signals or you can use your own risk management. It's not going to matter. And sometimes when I say that, I always say it's not going to matter. It doesn't matter. Long term, it'll all work out the same. Some people look at that and they think, well, you know, that sounds a little bit dismissive, right? What do you mean it doesn't matter? I just showed you an example where that guy made his profit and I took a loss. So now my official performance record for the VTS community on the website, you're going to see that in January, I had a losing Iron Condor, but he had a winner. So his results are going to be better than mine this month. He's going to see my results on the website. That's only one of 5 strategies, but his results might be better than mine. It's kind of makes a big difference. So why am I saying that it doesn't? Well, essentially what I'm getting at is what is called the law of large numbers. The longer you do something, the more this is not going to matter. So the law of large numbers is a theory that as the sample size grows, its mean gets closer to the average of the whole population. So put another way, if you all remember back to your old statistics courses in high school, this is the standard Bell distribution. If you're talking about one occurrence, this is going to be a very wide Bell distribution. You can get all kinds of results for all kinds of different people in the community. As we said, that guy made his profit, I took my loss. We're on opposite sides of the spectrum for one trade. But if we take 10 trades, it's probably going to balance out a little bit better. Probably going to have a situation where he did better on 2 of them, I did better on 2 of them, the other 6 are kind of a wash, and we're going to start to converge to the center of this Bell distribution. If you do it for 100 trades, at that point, the whole community is going to start converging on a price and a performance level that's a little bit closer. So Law of large numbers essentially means that the more occurrences you do over time, the less this is going to matter. That's why I always say, just do either. You can either follow my trades exactly, and there might be times when you look back and you kind of kick yourself. You think, oh, you know, mine crossed, his didn't, I wish I closed it. But what you'll find if you do enough occurrences is there's also going to be times when I do something that benefits you, and if you would have followed your own trading plan, it wouldn't have benefited. Or you can do option number 2. Once you get into the trade, you can exit at 50% based on your own premium. Again, not to sound callous here, I don't mean to dismiss, the reality of financial changes in our portfolios, but it's really not going to matter long term. And that's the same for the VTS performance on the website. I get people sometimes, like in several live streams, I've mentioned that 2022 was kind of a rough year for 3 of our strategies. 2 of them did really well, but 3 of them did not. The trend following UVXY butterflies did really well. The Iron Condors crushed it for me. I think I made something like 26% last year in 2022 for the Iron Condors. So great year for that strategy, but the other ones didn't work out so well. The trend following, because all of these assets were down, it's pretty difficult to be profitable when everything that you could potentially be holding is down, right? So it was a losing period for those strategies. But I've had people email me and say, I saw your recent live stream. You said this strategy did X. Mine did really well. What are you talking about? And I had to explain this law of large numbers to this person that, look, 2022 had many days. If you remember back, it was a wild year. There was many days where the NASDAQ, for example, intraday changes might have been 6, 7, 8%. And in some cases, we're using 2 times leveraged ETFs. So you could be talking about a 10, 12% difference with one day on a trade. It could really matter if you're talking about 1 or 2 trade occurrences. There were times last year where if you took a trade at noon versus taking a trade at 3 in the afternoon, it could have made a 10% difference. But the more occurrences that go by, the more it's all going to converge to the middle. So there were individual days where some people in the VTS community had a trade that went awesome, and some people had one that went really badly. And then 3 weeks later, it might have been the opposite. Maybe the market started red and we made a switch, and then later in the day, it totally recovered. It's one of those things that you just have to have the long-term experience to know that day-to-day noise is just that. It is just day-to-day noise. We can't control intraday pricing. I have no idea whether noon, 2, or 3:30 is going to be the best time to fill a trade. I have no idea. What I do know is if I do it 100 times, the good's going to cancel the bad, and it's just going to be my track record, right? So the longer you follow something, the more it's all going to converge to that bell distribution. And this is a perfect example of it. That person that said this trade, congratulations. He made his money. Good to see. I did not. I had a stop-lossed out trade. That's going to be part of the track record going forward. It is what it is. But maybe a month from now, I'm going to be on the winning side of that equation. It's law of large numbers, just one of those things where as a trader, you really have to put that out of your head. We can't control intraday pricing. Humans have this cognitive bias where we tend to focus on outcomes that went against us, and we tend to ignore or forget about things that benefited us. It's just, some people are the opposite. Some people focus on just the good and they totally forget the bad, but the majority of people will remember all those times that, I should have traded at 2 o'clock and look at the price is so much better. I got screwed, right? We tend to remember those a whole lot more than all those times that I bought here. Thank God I bought there because look at what would have happened if I waited 2 hours. We tend to forget those, just shove them under the rug really, really quickly. So law of large numbers, it's really, really not going to matter in the long run. Again, if you email me and you ask questions about what time of day should I take my trades? I'm going to give the same cold answer. Long term, it doesn't matter. It's all going to cancel each other out anyway. It'll be a wash. What you do tomorrow might matter, and it might deviate from what I do. Your results last year might be better than mine. Your results last year might be worse than mine. Long term, we're all going to be about the same. So hopefully that made sense. Just one of those things. Trading is trading. The more times you can eliminate variables out of your control, the better your emotions are going to be. Because we can only control our controllables, the things we actually have control over, our strategies, our inputs, our position sizing, our stop loss, our risk management plans. We can control all of this. What we can't control is surprise Fed announcements, government intervention, intraday pricing, a flash crash, a cyber attack. We can't control any of those things, so don't take it into account. Eliminate that. You only focus on what we can control. So when I'm ready to take a trade, I just take the trade. I don't sit there thinking, okay, I've got to get into the NASDAQ. Should I do it now or should I wait an hour? Oh, maybe I should wait till 3:30 today. I feel like that's going to be a better time. No, if I get a green light to take the trade, I just take the trade. I just do the best I can. So hopefully that's clears that up for the stop loss people that actually did have a winning trade. Congratulations to everybody who did close that trade out. It got close. Like, it was one of those things where we opened it here. And of course, in an Iron Condor, you want it to stay sort of close to the middle of the price, right? So it started out as a loss, and then it recovered really well, and it was doing well. And then it was pushing, kind of high here. It was pushing to the high side. And then the market crashed on that one day. And on that day, it went from being basically a break-even price to nearly a stop gain. We nearly could have taken the profit there. But it wasn't on my computer, what I was looking at, it wasn't quite there. And then, of course, the next 5 days, it screams higher, and we stop loss out. It was just one of those trades. But this also gets back to the early thing that we talked about. You don't want to, no, that's not what I'm looking for. You don't want to close them out too early because there is fluctuations here. You want to allow your trades to be down a little bit. You want them to be up a little bit before you take your profit. I feel like 50% is a really good number. So that's what we go with. All right. What time is it? So this is episode 49 of my live streams. And not once have I ever even been close to the 1 hour cutoff of this live stream. Not even close. I think maybe once I cut it off at an hour and 15. But I mean, I've done live streams over 3 hours long. It's just, my time management on live streams is the worst possible. It just, I don't know how. I look up and it's 11:30. How's that even possible? But I answered everybody's question, I believe. This new one came in. Oh, sorry. I hate when I flash it and then I have to go back. This is a new one as well. Market makers, they do what they do. We just don't do 10 cents, 20 cents. It just wouldn't make sense. All options are, zeros and 50 cents. It just makes it easier on their part. I suppose you could do anything you wanted, but that wouldn't make sense because you're dealing with one option contract is equal to 100 shares of the underlying. You kind of want to keep it to, something that is easily divisible, right? Technically, it's computers. You could do whatever you wanted, but that's kind of silly. Plus, there's clearinghouses and all these things. So it blows my mind that it's been low for a while. They could have split it at 7 or 8. Just don't know what's going on with them. All right, last question. Some of our previous UVXY put butterflies had prices of only 1 or 2 cents, particularly the lower strikes. Yes, that can happen. Given the low prices, is there ever a time when you would opt to just buy the highest strike? Do you mean closing them out? Yes. I think I did an article on that, I'm going to say a month ago. So sounds like you're in the community. You would have seen that article. Essentially, yeah. So if you've got a broken wing butterfly, and it's going to do it on the VXX. If you've got something open, let's say, because it's expiring today, so let's build one that looks like it's expiring and it's in the money. So let's say you had the 12, 11, 10, okay? And then the premium for this, let's say you opened it for a premium of about 15 cents. That's kind of typical for us. So this is what your trade would have been like. You would have had losses on both sides and then a profit here. Because it's expiration day, this trade has to be closed because this strike is in the money. So if you left this to expire, you would actually wake up with short shares in your account, which you definitely don't want. This one also could potentially go in the money, so you'd want to close it. But let's say that this 10 strike, the liquidity is so bad that you really don't want to execute this as a whole trade. You could, if you wanted, actually in this case, this is a bad example. I'm going to go 1150, 1050, 950, just to make it really clear here. So you could, if you wanted, just close this strike. And then you'd have to kind of watch your computer the rest of the day to make sure that this one's not going to be in the money. You don't want to make that mistake because then you're going to be long shares. But yes, you could, if you wanted, just close this one out. This one will expire worthless. This one will expire worthless, and you should be good to go. Because if you try to execute this 950, it's possible. It's not even here. How did I get that? That's crazy. I'm sure I'm just on a live stream too long. Something happened. Oh, it says not traded, of course. Yeah, it's not available. So it would have been a broken wing at 9. You're not going to get very good liquidity all the way at this 9 strike. It's just not there. You can see the volume, the open interest. There's nothing there. So yeah, go ahead and close that one. Be mindful that this one, you don't want this one to expire in the money, but it probably won't. That's an absolutely insane move. So yeah, just save yourself the time. Just close that one out. Tons of liquidity anywhere close to the money, and you should be fine. I do that sometimes. But when I'm giving the signals to the community, I'll typically make that very clear. I'll say this trade needs to be closed, and we open and close them as a spread. However, if you are pretty sure, or not pretty sure, you are absolutely sure that none of the other strikes are going to be in the money, you can just save yourself the hassle and go ahead and close just the one. It's totally fine. So that would be a long. You would just sell it to close, and you'd be done. You'd be out of the trade. The other two would expire worthless, and the following Monday, you would have cash in your account. All right. I breached it by a half an hour. That's not terrible. Okay, so hopefully everybody's subscribed to the Clips channel, and you've got the bell icon set to all, so you get the videos. And hopefully everybody scrolls to the top of the chat section and you sign up for my free newsletter. You definitely want to be on that as well. And that's it. I will think up some other topics for next week. So check the community forum. Of course, follow me on Twitter because everything will be posted there. And ask your questions, your pre-submitted questions. And I usually get to those first. I like doing that these days. Gives people a little bit of time to think up some questions. So thanks, everybody. Have a great weekend, and apologies about the sound. Hopefully it was okay. I'll see you next week.